Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending June 21st, 2019. Well, the theme for this past week, you guys have all heard about the book, Men Are From Venus, Women Are From Mars. Well, the financial equivalent is stocks are from Venus and bonds are from Mars. And before I go into that in a minute, let me just kind of talk about the global markets. This whole week was up. The Dow was up over 2.4%. S&P just slightly under that, about 2.2. The Nasdaq was up a solid 3%. The Russell was trailing at about 1.5%. We saw volatility come down just a little bit to 15.4, but the way we ended the trading day on Friday, I didn't like. The S&P E-mini futures fell 15 points in the last 15 minutes through into close, from about 28.63 to 29.48. Volatility all afternoon moved up 1 full point. So that's not a good way to end the week. Although we did see most of the global markets, the key ones anyway, have a strong week. I mean, the London FTSE was only up 84 basis points, with the Brexit issues they're trying to contend with. But all the others were up solidly. I mean, the French CAC 40 was up almost 3%. The DAX was up over 2%. China was up a whopping over 4%, 4.1%. And the Nikkei, again, only 67 basis points up. And the strongest sector was energy, with all the problems that we've seen in the Persian Gulf and what we've got going on with oil. I'll talk about that in a minute. Staples was the worst performer, coming in at just 40 basis points to the upside. And we saw the forward PE ratio come in around 7.3. So it's up just a little bit. Trailing PE is at 22.82, but I pay more attention to the forward PE versus the trailing PE. So anyway, getting back to our theme, stocks are from Venus, bonds are from Mars. Well, that basically means stocks. I mean, we're seeing record highs here, while bonds are driving interest rates to record lows. So it's suggesting stocks anyway, strong economic expansion, while the latter, the bonds and low interest rates, are suggesting more recessionary fears are coming. And clearly they've got priced in a potential Fed rate hike. It's amazing. We saw this month of May, markets fell over 7%. And then so far in June, we're back up 7%. I mean, but Lord knows we got enough fears that are out there. We resolved the U.S.-Mexican trade issues, but we've got central banks. They shifted their guidance lower, and their tone is more dovish now. So that helped. And we also saw some positive news on the U.S.-China trade front this past week, hit the news wire. So that tended to goose the markets this week. Although I will say, global interest rates now, we've got a total global debt yielding negative rates of over 13 trillion. Huge, huge. And this is all from this past December. The S&P is up over 25%. So from the Star Wars fame, the famed Jedi Knight Yoda, if he was a trader, he'd probably come out and say, "Careful, we must tread here. The dark side presence is everywhere." So, I still see a lot of factors out there that have led to, some of this volatile price movement, with the rising trade tensions, technology issues with governments coming after them, especially in Europe and here in the U.S., just kicking it off. We're seeing some slowing global manufacturing data, which is tending to lower global growth. And everywhere I look on TV, the talking heads are predicting gloom and doom, and recessions are coming, especially with an inversion of a yield curve. They're talking more specifically about the 2s over 10s. That'd be the 3s over 10s. That'd be the 90-day over the 10-year. But remember, it's got to be below 45 to 50 basis points for up to a couple of months for me to start worrying. Otherwise, it's a little bit more sensitive. I'm looking more at the 2s over 10s. I don't see an issue yet. But central banks all over the globe have been very accommodative. I mean, we kicked it off with Draghi last week, coming out and saying they'll be ready to support more stimulus, including more QE, believe it or not, buying bonds. Japan said the same thing, and then this past week we had our very own Power Ranger Boom Boom Powell come out and say same thing, right? About as dovish of a statement as you can get. So, with the talking heads talking about a recession and everything else, I see these lower rates is going to really spur more stock buybacks. I mean, last year we had over $1 trillion 2018 over $1 trillion in stock buybacks is projected to go higher this year. So that's going to help with PE multiple expansion along with the low interest rates. So I can see the markets moving up to 30, 50, 3100 levels before profit taking and a shift in overall market sentiment really is going to force kind of a more of a defensive action. I think the eventual undoing is probably not going to be trade tensions or any of that other stuff. It's probably going to be higher interest rates. It's going to probably be the undoing of U.S. equities. You know, if you look at it over the past 20 years, our gross debt has risen. Total debt has risen from about $5 trillion to $22 trillion, while interest rates have fallen from 6.5% down to about 2%. Now imagine those interest rates moving up higher, servicing that current debt level of 22 trillion with higher rates. It's going to force politicians to take very hard actions against our debt. It's going to force inflation up, and the equity markets are going to be punished severely. But we're not ready just yet. We're still taking advantage in our user group of markets moving higher, and I just believe they can. You know, we still got a little bit more of that FOMO left before rational heads kind of jump in there and move things lower. But the probabilities of a rate cut, according to the bond market and the 30-day Fed Fund futures, is almost 100%. I don't think I've ever seen it that high for not one but two rate cuts. Some are even saying three, and we've seen a severe shift in the Fed's talking points, and therefore guidance would suggest at least one more rate hike is near. But I just think a lot of that is already priced into the current stock price right now. You know, we're trading at about 17.3 forward PE ratio, as I said, and the peak last September, which we just took out, was trading at 17.34. So I think the markets are a little bit too overly optimistic that things are just going to work out fine. You know, and in my experience in the markets, when everybody moves to one side of the boat to see the whale breach the surface, that sucker swims underneath the boat and surfaces on the other side, leaving everybody on the other side of the boat wondering what the hell happened. So we just have to be very careful, as Yoda would say. We also saw gold break out this week, up over key levels. And I told our user group that the break over 1375, if it holds, we have a retest and hold, and I think it can run up. And that's what we're getting right now. For the week, gold was up about 4.14%. And it was the first time it broke 1400 since 2013. So that's a significant number. And gold tends to trade very technically. You know, it's supported by a much lower dollar, lower interest rates. And because gold doesn't yield interest rate payments or dividends, but the fact that we've got negative yielding interest rates to the tune of 13 trillion in global debt kind of helps money just ferret over to the gold market, not to mention more of a hedge against escalations in the Persian Gulf and weaker U.S. dollar, so forth. So, you know, should it maintain upward momentum, I think it can move higher. And just looking at gold over the Dow, I mean, Dow right now, about 19 ounces of gold to buy the Dow. All right. And that was it took 22 ounces of gold to buy the Dow last September. Although we did see when gold was at its trough, it took only about 7.8 ounces to buy the Dow back around 2011. But I still think gold's got a little bit more ways to run. Now, what are the headwinds with gold? Well, if interest rates start to rise, that can, and the dollar strengthens, then that'll take some of the momentum out of gold. But it's been building a base for quite some time. So I do think near term, gold's got a little bit more room to run. All right. The other thing is, remember, technology, we're seeing some shift from some of the FANG stocks into some of the collaborative software and 5G stocks, which, you know, we're tracking in our user group. Those things are working out well. But in general, though, XLK, technology sector, communication sector, real estate sector also looks very strong, XLRE. So when I say real estate sector, I don't mean home builders like Tolles and Beazer Homes and Pulte and things like that. I'm talking about REITs, because in low interest rate environments, dividend paying stocks, you know, they tend to hold their value fairly well. Money kind of goes in there seeking yield. So we'll see that kind of play itself out also. Well, what I've got on the screen here is a weekly chart of the E-mini S&P 500 futures. You can see here we've made higher highs, going all the way back to January 2019 or 2018. Um, and the definition of a trend is higher highs and higher lows. Now you can see this washout that we had in December. I attribute the last 10% of this move to Super Mario Draghi. Not Mario Draghi. I don't want to blame him. Power Ranger Boom Boom Powell, when he came out on December the 3rd and said quantitative tightening is on autopilot. I see 2 more rate hikes in 2019. The markets were screaming, don't even do a rate hike in December, which he did, of 25 basis points. So the market sold off an additional 10%. If I were to draw a line on that time and that date, it puts it right at that area right there. Okay. So this piece right here was a Fed misstep. So this is kind of what I view as more of a true support area, assuming we've got an accommodative Fed right now. Okay. And so we've got higher highs just like that. And the lows, we had a low here. And then if you make that assumption, then you could say we got a higher low here and then a higher low here. It would run something like that, right? Something like that. Which could be a rising wedge, which eventually it breaks to the downside, right? And again, I discounted that Boom Boom Powell misstatement on December the 3rd, because on January 3rd, he came right back out again and said, my mistake, or January 4th, my mistake. We think Fed, our interest rates are in a normalized mode right now. We're going to stand down a little bit, and then boom, away we went. So you can see how the central banks can rocket price action dramatically. You can see my target here was hit perfectly. My next target is sitting up here right around 3,100, as I said in the open. So I think, that fear of missing out, that FOMO, can drive more money off the sidelines. There was about 30% in cash sitting on the sidelines. And the higher it goes, the harder it is for people to sit on cash. That's just the way the markets work. So, we may come back and test a little bit of a support here around the 2,900, 2,892 area, somewhere in that area here. We've got a value area on the weekly chart sitting at 2781, so just south of the 2,800. So in this regression channel, we could even come back and test it here. But I still think the uptrend is still intact. And that would drive us up to this area right here. As I told our members, it's not a straight shot, although you would think it was as we kicked off the month of June, making up the downswell that we had here. And these big pivots, you can see this V move here. You can see this V move here. Folks, that's not natural. That is caused by central banks and Fed announcements that they just get things wrong, right? And they just come out and they shift their tone. And we had that here, and now we're getting here a complete reshift in a stance again, meaning more rate cuts and are standing by for more stimulus. We got that from the Bank of Japan. We've heard it from China. We've heard it from the central banks in Europe, the ECB. We heard it from Draghi this past week. So that's what creates these V bottoms. All right, these V bottoms normally are not natural. Normally you'll come down and then you'll come back. You may do a retest. You may even go a little bit lower, and then you'll kind of work your way back up and kind of a rounded bottom. That is a more classic case of how bottoms are formed. Okay. And topping actions are kind of the same too. A lot of people like to say bottoms are classic V, but generally you don't get that. You'll get a move down like this. You'll have a pivot point, and then you'll come back down and probably test that pivot point, maybe even move a bit lower before you start shifting tone and working your way back up again. Okay. So we've got that just classic V here on December 26 intraday lows, and then back here to in May going into June. So these things we're seeing more of, and it's because these damn central banks they're clearly coordinating this effort. Markets believe we're going to go higher, but we need to be very careful here. Okay. As the Jedi Knight Yoda says. So this is kind of what I'm looking at on the E-mini S&P. You can see here, if I take it back, and let's just go take a look at a daily chart here for a second. You can see this classic V move right here, okay? Down and up. This was about a 7% move lower. about a little bit over a 7% move higher. All right, we made 2019 all-time highs. You can see the 50 EMA and the 200 EMA in an upward trajectory. We're within this wider regression channel here. You can see the value area. I've got a couple of them, one sitting around 27.91 and another around 28.90. So one, call it 2,900 and the other at 2,800. Right. And the end of May gave us a low of about 27.29. So, I mean, we've just really rocketed higher, just dramatically. I'm looking at any divergence signs. We do not have any near term, so that suggests any sell off is going to be met by buyers coming in. And you may be wondering, well, what are they buying if the global economy is slowing down? But you got to understand, we're back to where we were 3 years ago. Tina, there is no alternative, right? If you've got interest rates, 13 trillion, yielding negative interest rates, and you got these big retirement funds, sovereign wealth funds, and teachers' pension plans, state, local pension plans, they've got to basically make yield, and that forces money back into the equity market. And a lot of equities are taking advantage, or a lot of companies are taking advantage of stock buybacks, low interest rate, borrowing, buying back your own shares, reducing the outstanding float on the shares, which drives up earnings per share, drives forward PE multiples higher. So this just tells me everything can move up. Now, keep in mind also Q1 earnings came in better than expected. Q2 is expected to come in very low too. So if we see Q2 earnings come in at or above the bar, and the bar is very low still, then we're going to continue this run. Like I said, the odds favor is moving up to, 30, 50, 3,100 area right here. And then we're going to get some more serious profit taking coming in, okay, as we go into the latter half of 2019. And then in 2020, it's all going to be about the presidential elections here in the U.S., Dems versus Repubs, and what would be the best sectors to be in, depending on who wins, okay? So, and depending on who controls Congress and the Senate. So we don't need to worry about that now, but that will be coming. But what is coming is we got a major debt issue and budget issue that's going to be addressed in September, and they're going to start talking about it in August. It's got to be resolved by October 1st, or we get continuing resolutions which can introduce more volatility back into the market. So this is what I'm looking at right now. The location of price action to the 50 and the 200 EMA all indicate bullish. We've got a little bit more upside, I believe. Near term, we can probably pull back a little bit, but I think the odds do favor more money coming into longs right now on the E-minis. If we look at, and we made new 2019 highs, and if we look at NASDAQ, you're going to see an all-time highs. 2019 highs, all-time highs also in NASDAQ, but we did not make new highs, all-time highs, since we gave them up in late April of this year. Okay, we did make them in the S&P. We did not make them in NASDAQ. You can see we zoomed back up, but we did not quite make them yet. All right. If we look at the Dow, we did make 2019 highs again this past week, but we have yet to make new all-time highs, which was made back in September. But we're very close. All right, you can see just how close we are. Just a couple of points, I guess. Dow points. We took out the prior 2019 highs that were made in April, and this big move lower in the month of May. So the Dow is also on path, and you can see the 50 and the 200 both pointing with an upward vector, both moving up, both getting some separation. So any pullback here is probably going to be bought, guys. I would not be surprised to see a little bit of a pullback, kind of digest some of these gains here. But I do believe we can be a kind of a sideways to chop a little bit until we resolve this big move here that we made in June. The only one that's really hurting is the Russell. Now, if we look at the Russell, notice we did make 2019 highs in the early part of May, but look at how far away we are from our all-time highs made in September, right? And we're sandwiched between the 50 and the 200 EMAs, but notice that the 50 is still below the 200 EMA. So we've got a lot of damage that was done with NASDAQ. It is trailing the other markets the most that it's ever trailed them in over a decade. So it's just it really needs to play pickup here. It could be the canary in the coal mine saying, "Hey, we're going lower." As you can see here, this is a weekly chart. You can see the highs that we made back in September 2018, and it's not looking as good. You know, home court advantage they do not have, right, for the S or for the Russell. So if we just look at this chart here, um, we did make a higher high here and a lower high here. So I've got some key areas that I'm going to be watching in the Russell, but it is not pretty, guys. We need to see some strength come back into the Russell here. If we do not see that, I've got a value area underneath around the 1500 to 1510 area. So I could see a pullback there, but if we do not hold the 50, it's going to be ugly for the other markets as well. Right? So now one that should do fairly well with very low interest rates is emerging markets. And with the dollar coming down, you can see here the emerging markets really took off in the month of June. And this lower dollar has really put some oomph in the emerging market. So as I said, as long as interest rates stay low, it should do okay. Now remember, China's the big dog, and China can control a lot of where these emerging markets go. So I'm kind of staying away from emerging markets right now until we get a resolution in the China U.S. trade deal. Otherwise, I'm going to kind of stand down until I see what's going on there. And speaking of China, if we look at the tracking stock for China, Asher, you can see it is up off the lows that it made, towards the end of May, like all the others. But this is going to go where the trade talks with Trump and Xi go. And when you know it, they're going to be talking next Friday and Saturday. I don't know why it always is the weekend where things come out. I wish it would come out during the trade day where you can react to it, but that's not what's going to happen. So it's going to be one of those weekends where you're going to see people hedging off going into the weekend unless some kind of policy statement is done before markets close next Friday. All right. Now, the other one that is just really having a difficult time, like the Russell, is the transports. You can see the 50 crossed back below the 200 here back in May, and the 200 is acting as we just can't get up above it. Now, we've got a key earnings announcement coming out this Tuesday. FedEx is going to have their quarterly results. All eyes are going to be on FedEx, and it's going to people want to see because it's kind of a good prognostication of where global markets are going and where U.S. is going under the theory that if people are buying more stuff, FedEx is shipping more stuff. So we'll kind of see how that thing plays itself out. But just looking at transports, this does confirm that global markets are slowing down, and we'll see how long low interest rates keep equity markets higher. Um, of course, if we look at volatility, you can see here where we moved from the green zone right back into the yellow zone yesterday in the afternoon. We were in the green and then we closed back into the yellow here. Yellow zone is generally what I classify as anywhere from 15 up to about 22 VIX. Okay. And we have not had a sustained bout in the red zone or the pink zone since the Q4, especially December, right? It's very hard to maintain a VIX at this heightened level for a longer period of time, but we managed to do it in the month of December. In fact, we went into the red zone all the way up to about 36 in the VIX, okay, until we came screaming back down with the huge run that we had to kick off this year into Q1. But I could see us moving back up should we have any negative issues with Trump and Xi. All right. So volatility is not taking the bet, or is they're going to take a little bit of a hedge. So you're probably going to see some more hedging next week going into that meeting coming up. Of course, if we look at the front month skew, right, you can see we're in green. So that means we're in a contango environment, which means we don't have an elevated skew yet in volatility. All right, that's the front month. That's the VIX compared to the July futures. And if we look at July and August futures, that would be the back month. You can see here we're well into the green. So we've got a contango skew, which shows no fear going out in time so far. All right. So I watch these front and back month skews just to see, is the fear heightened or is it just a short term kind of let's just hedge real quick for a particular binary event? And generally, this is a good tool to use to kind of just see where the skew is falling right now. And of course, if we look at treasury yields, bond markets, they're still extremely elevated, way up at this level up here. I still favor more shorting. We had a divergence right here, which would suggest picking up, and I told our members this past week to pick up some puts in TLT. All right. Not that it can't go higher, because it can. Interest rates can always go lower. The lower interest rates go, the higher the bond market goes. But I think near term, picking up a couple of puts in TLT makes sense to me, right? Just playing a little bit of this contrarian move back lower. Not a dramatic move, because interest rates are going to stay relatively low. But I think at least back into this pivot range here, the middle of the pivot range is putting us right around 153.11. Of course, if we look at the interest rates themselves, if we look at the 10-year, you can see that we're at 2019 lows. I mean, this is just, to me, totally amazing that we're near all-time highs in interest rates. And let me just put it on a weekly chart just to show you. If we go look at the 10-year interest rates, I mean, these were the lows here, 1975. The last time we saw that was back here in 2016, guys. And we're at all-time highs in the equity markets, most of them, except from the Russell. Is just totally amazing. So that's why I said stocks are from Venus and the bonds are from Mars. One of them is going to work out right and the other is going to be wrong. Near term, I do believe equities have a little bit more FOMO push to the upside. But generally speaking, the bond market and the liquidity and interest rates and the credit markets drive equities, not the other way around. But you can always have an overshoot, which we always do in the equities, both to the upside and to the downside. So just understand that, all right? For our members, there'll be some trades that we'll be talking about this Sunday night in some of this. Look at the dollar. It's given it up a lot recently. You can see this regression channel moving up. This is a weekly regression channel, all right? Or a weekly chart showing the regression channel, how we've moved up and down. If I show the daily, you can see here just the big move lower here in the regression in the dollar. It's moved down to the lower side. In fact, we moved below the 200 EMA, right? And the last time we held it was back here in March of 2019. So I'm going to watch this closely, because the lower the dollar goes, the higher gold can go. This is kind of catapulted gold. So be careful chasing gold right now. But this would suggest that I think the global markets, Boom Powell and Super Mario Draghi were on the phone. They were talking with Kuroda, who's the head of the central bank in Japan. They were probably talking with the Bank of England as well, but primarily Bank of Japan but primarily Super Mario with Europe. And they're coordinating this effort here, which drove the dollar down. Right. And then, of course, if the dollar goes down, then all likelihood the euro is going higher. And as you can see, the euro actually climbed above its 200 EMA. Now, that regression channel has been on for a long time. Excuse me. We popped into this regression channel in the summer months of 2018. And this is where we're sitting right now. And you can see the 200 EMA is starting to flatten here. So this tells me we're going to have some sideways chop in the euro. But we did have headline news, and the charting action suggested we were going to move up. And if you guys remember, a couple of weekends ago, I was saying being long euro dollar is where you want to be. And that's sure enough what's happened. All right. So that's kind of playing out here. If we look at if we look at gold, the oil, we're coming right back into my range, which is the mid 50s. This move here is strictly on geopolitical events, mostly wartime stuff, politics wise, in the Persian Gulf. I think, and keep in mind, on July 1st and 2nd, or 2nd and 3rd, OPEC's meeting in Vienna to come out with what they're going to do. Everybody's trying to get into agreement on production cuts. Saudi Arabia wants production cuts, the others don't. So let's see what they come up with. They're trying to stabilize the price of oil. Oil's been all over the place, but we at our user group have had great calls. up in this area here, I was having everybody short oil. I said the mid 50s is kind of where we're going. We blew right through it, came all the way down here, and then I got a bullish signal the end of December. I said mid 50s is where we're going. We came up, we hung out here for, oh gosh, probably about 3 months, and then we moved up on geopolitical events in the Persian Gulf. And then I said that's a little bit overdone. We should come back down to the mid 50s. I had people shorting up in this area here. We came down through the mid 50s, back down in the low 50s area. Now we're shooting back up. So if you've noticed, we've been right directionally, but we've kind of overshot our target, which I guess is good, whether you're long or short, because that means you're making more money. But oil tends to overshoot because the fear and greed play a lot into the oil market. And now that we got the Persian Gulf issues, you know, when we're around the mid 50s, I stand aside until we get a little bit extreme again. So if we can get back up into this area up here, or back down here, then I'd be more interested in playing it. But right now we're kind of in a value area here. The value area for oil is around 56.88. We closed at 57.60, so that's close enough to this value area that, which is where most of the volume a lot of volume took place. We also had a lot of volume take place around the low 60s, 62 area. So we could run up into that area and then run into some more resistance. So I'm going to stand down and just get a better picture of what we want to do here. Now, gold, as I said, in the gold market, we've come right up to my target right here. Let me just back it out to give it a little bit more context. You can see the targets. Oh, it's a weekly chart where I put the target. So you can see here, we broke out of this level right here, as I said, around 1375, 1376. That breakout, that was my target at 1405. We came up to 1403. Right. So the target was really hit, well defined. We may have a retest of this ascending triangle. You can see this long build out base, which is really actually stronger when you got a build out like this, right? Then you may have one of these kind of things, and then boom, away you go, something like that. So right in this area is not where I want to be going long. I want to see if we can get a test down in this area. So any pullback I would be more interested in. But again, we've been talking about this for quite some time with gold. And then when it built that pattern up longer term on this weekly chart, that just means that to me, longer term suits that, right? More to the upside. You can also look on the short term basis here, right here like this, and say, let me just kind of swing it out a little bit here. You can make the case, or a little bit of an argument. It's not an ideal. People see patterns like they see in that movie Dead People. There's a pattern right there like this, right? So you could draw this line like that and say it's kind of a head and shoulders, inverted head and shoulders. So when we break there, the target is roughly the distance from here to here. You know, so if you take a look at that distance, that's around 1360 less 1180. So that gives us about 180 point upside here from 1360, and that moves us up to about 1540. All right. So this reverse head and shoulders pattern on a short-term basis takes us up to about 1540. You know, so if I were to take a look at this, it would move us right up into this area here. As you can see, I've got some Elliott Wave 5 drawings on the chart that suggest, you know, the 1540 is almost right between my Elliott Wave 5s. This is an Elliott Wave 3. So note on an Elliott Wave 3, typically what happens, this would fit into that cup and saucer pattern, guys, where you come up, then you get a 3-leg, then you get a little bit of a 4-leg profit taking, and then you move right on up to the Elliott Wave 5 right here. So in that break of that head and shoulders, that does suggest, but, you know, where is this pullback going to occur? Is it going to occur here, here? Who knows? But we do know we're not going to go straight up. That's just not how markets move. So any pullback for us in our user group would be an opportunity to come in here. All right. Some already took the break right here in the trade on that break. So you're up, you know, nicely, but that was a key break. So I just wanted to spend a little bit of time on gold now, and it'll be supportive as long as dollar stays in that lower half of that regression channel and stays down a little bit, as I showed you earlier. We had some good trades in palladium, which I'm not going to go into. Same thing with corn, and especially corn. Corn has had this huge move up in this area right here. We got a signal to sell it right in this area here, but not in a long-term sell, but just a short-term, just playing this contrarian move right here, back down into this uh, middle of this pivot area, which would take us back down, around 419 a bushel, something like that, and then it'll consolidate. I think we got one more oomph to the upside in corn, and then that'll be it for corn near term. Right, so that's kind of what we're looking at. We've also got some things in meats and softs that we're also flying high on. So these are just some of the things that we're playing. For those of you that are not in our user group, highly encourage you to come in. We've had great years. I've been running the group since, or I started the group in 2008. And 08 and 09 were great years for us because we were trending and we were moving strong. And then we've had some good years behind us. So I'd like to see you guys that are on the sidelines, just looking at the weekly roundup free updates in the weekend. Come on in and join us. You'll come into our chat room. You'll see what we're doing. You'll see some of the trades that we're taking that it does not matter which way price action goes. We're going to win either way. Same thing with volatility, and especially for those of you that have portfolio margin. Those of you that have it know it, and we know how to leverage portfolio margin really well with some of the strategies that we play. All right, everybody, have a great weekend. Members, I'll see you tomorrow night in our weekly market watch. Take care, folks. Ciao.